Good morning. Mortgage rate trends and what they mean now. And mortgage rates are currently sitting at their lowest levels of 2025 and early 2026. And this shift is creating a meaningful window of opportunities for both home buyers and homeowners who are considering a refinance. Now, while rates move daily, the broader trend matters more than any single headline. And right now, that trend is clearly pointing lower, driven by cooling inflation data, shifting Federal Reserve expectations, and ongoing volatility in bond markets. So for borrowers, this is not a wait and see environment, it's a prepare and position environment. And why mortgage rates are dropping now. Mortgage rates follow the bond market, not the Federal Reserve directly. And over the past several weeks, we've seen that Treasury yields have declined. We've seen that inflation data has softened. We're also seeing that markets are now pricing in future rate cuts, and that's a big part of why rates are coming down again. But investor demand for mortgage backed securities has also increased. And the result is that lenders are offering better pricing and improved credits and more important competitive refinance options that we've seen all of last year. So, what this means for home buyers. Now, if you're actively shopping for a home, lower rates are going to increase your purchasing power. So, that's one. And likely you're going to see a lower monthly payment as a result, and that's much more manageable. And sellers are becoming more flexible as inventory is starting to grow. And builders are offering stronger incentives tied to their financing. Now, a rate dip can be the difference between qualifying comfortably versus stretching, especially when you get into the higher price points. And that's why pre approval now matters more than the perfect timing for later. So, what this means for people who are considering a refinance is that for homeowners who purchased or refinanced in 2023 or early 2024, or even back to the beginning of COVID, rate and term refinances will likely make sense. And FHA borrowers may benefit from conventional options. Now, adjustable rate borrowers can explore fixed rate security as well. But we're seeing a lot more cash out refinances that could be viable for debt consolidation for those folks that need it. And even a modest rate improvement can generate meaningful monthly savings, especially when paired with term optimization. So the risk here is playing the waiting game, really. And rate cycles rarely move in straight lines. So when demand returns quickly, pricing worsens just as fast. And we've seen this movie before, is the bigger point here. The rates will drop and your applications for mortgages surge. And then lenders reprice upwards to slow down their volume, which means that opportunities shrink again. It's a seesaw balancing act. And the borrowers who benefit the most are the ones who prepare early and lock strategically when pricing is at its best points. And we're here. The bottom line is mortgage rates are currently at the lowest levels of all of 2025, but in 2026, and windows like this do not stay open indefinitely. Now, whether you're buying your first home, moving up, or exploring a refinance, the smartest move is understanding your options before the market shifts again. And in Medallion Funds, we monitor rates daily and structure strategies around market timing and not guesswork.